from San Francisco. It's great to have you all here today. All right, we'll get started here. First off, welcome. Thank you all so much for joining us here today. Before we get into the presentation, I wanted to take a moment to introduce Pacific Community Ventures for those of you who may not be familiar with who we are. Pacific Community Ventures is a nonprofit dedicated to the support and success of small businesses. Our mission is to invest in small businesses, create good jobs for working people, and make markets work for social good. And we do this through our impact measurement research and consulting program, our fair and affordable lending program for the state of California, and our nationwide free business advising program, which is bringing you this presentation here today. If you aren't already working with a free business advisor through our business advising program, I'll follow up in the chat and also in an email later today or tomorrow with the link to get started, because we'd love to connect you with an advisor to help you through any challenge or opportunity that you have in your business here today. So like I said, I'll drop that link in the chat and follow up via email as well. And without further ado, I do want to pass it over to Tania, who's one of Pacific Community Ventures volunteer advisors. She's joining us to help us determine the types of credit for our business needs, understand where we stand in terms of our credit profile, how we can develop a strong financing application, and all these things. After working as a financial advisor and a premier banker, she decided to use that learned expertise to her own venture and founded TF Wealth Advisors, where she serves as a senior investment advisor. If you have any questions for Tania throughout the presentation, feel free to drop your questions in the Q&A box. And we've built in some breaks to address those questions throughout. But without further ado, I'll just pass it over to Tania to kick us off.
Thank you, Morgan, for that introduction. Thanks, everyone, for being here and taking time out of your busy schedule to join the call. Hope everyone had a great weekend, and I'm hoping this will be a good investment of your time as well. As Morgan stated, the presentation is going to focus more on understanding your business credit report, the four major types of business, as well as how to position yourself for success if you do decide that business credit is the best option for you. So if you started your business generally, let's say if you started your business without seed money or without an investor, chances are that you have considered business credit to meet some of your business needs. So we'll cover those objectives as well as some best practices to put in place to help you better position yourself for success. So the slide on the screen here, I think it's very interesting. This was some good statistics that was pulled from nav.com, which is a great credit resource for small businesses. But it states 45% of small business owners who are denied financing get turned down more than once, and 23% don't know why their applications were denied. And then small business owners who understand their business credit score are 41% more likely to be approved when they apply for a loan. 45% of small business owners don't know that they have a credit score, and 82% don't know how to interpret that information. And lastly, it says those who understand their business credit profile are 31% more likely to consider expanding their business because, of course, credit does give you the ability to have more access to capital. Next screen, please, Morgan. So I thought this was really interesting information. I'm curious, though, if you can put in the chat box what you hope to get out of this presentation. I'll do my best to cover that and as well as answer any questions that you might have as well. So what is business credit and why is it important to you and your business? As stated in the stats previously, most of us don't know that we have, as business owners, we may not know that we have a business credit report, but we do, just like we have a business credit report for ourselves, we also do for our business as well. And the information contained in your business credit report mainly lets lenders, potential customers, and partners assess the risk of doing business with you or your credit worthiness. Of course, credit is an important part of any business when it comes to growth, or if you're starting your business, established business. Of course, credit might look a little bit different for you, but it does help you meet a short-term need. As an entrepreneur, it's important to understand that your personal credit and your business credit does play a factor when you do go in and apply for credit. Corporations, when you become a corporation, then they may just look solely at your business credit. But before then, your personal and business credit is a factor that most lenders will assess. And of course, maintaining a good credit profile does help you grow and sustain your business. That a bad credit profile can hinder your ability to grow your business. All right, next slide. So we're all familiar with the information that we have in our credit profile on the personal side. No matter if you requested the information from Experian, Equifax, or TransUnion, you know what type of information generally is included in that. That's your personal information, your account information, as well as any tax liens, repossessions. And you know generally what the range of scores are. That's 300 to 850. But on the business side, there's not a standardized format or reporting that it's required. So for instance, if you were to request, or if a lender were to request a credit report for your business and they chose to use Dun & Bradstreet, the information contained in that could be potentially different than Experian business or Equifax business. But your business credit profile is a reflection of your business and how you've met all of your previous financial obligations. A business credit profile could potentially include identifying information for your business, much like the personal information in your credit profile on the personal side. And then, of course, any history with lenders, any delinquency with lenders, and background information or public information. It's important to note, though, that your business credit profile is not subject to FCRA as personal credits are. So that means anybody can access your credit. Now, you could be a customer, it could be a partner. They can access your credit before deciding to do business with you. So it's important to know what information is contained in that. That's not to say a stranger who doesn't know you would go access it, but it is possible. They pay a fee, they can access your credit, your business credit information. So I keep that in mind. Next screen, please. So now we'll talk about the three major players in credit reporting agencies. Of course, that's Dun & Bradstreet, Equifax, Experian Business. Most of us are familiar with Experian and Equifax because they are the major players in our personal credit side, but they also have a division that handles business credit. Dun & Bradstreet is one of the biggest. They focus exclusively on your business credit, your interaction with suppliers, interaction with vendors as well. And they assign you what's called a paydex score, which it's just generally how you've met your payment obligations, so your performance. And it ranges from 1 to 100. Generally 80 to 100 being a good range that you want to aim for. Equifax focuses on how you've managed credit lines and loans, and they provide a delinquency score and a failure score. They have various types of scores. So if someone wants to find out what the likelihood what's the likelihood that your business would fail in the next 12 months, Equifax has a report for that and a score for that. If they want to find out what's the likelihood that you'll default on a loan, Equifax has a score range for that. So Nav.com has all that information. It's actually very interesting that they can analyze and score all of that information, but it's packed with it. But generally, the score ranges from 101 to 660. And then Experian is a combination of Dun & Bradstreet and Equifax. So it includes all of the information that you could potentially pull from Dun & Bradstreet and Equifax. their score ranges from 0 to 100, with 0 being a higher risk. So scores are based on numerous factors. They had several, but generally outstanding balance, payment habits, credit utilization. Those all make up the scores that Experian does generate for you. Now, if you pull your Experian credit report and you don't see a score, it's okay, because it does require a minimum amount of information to be available before it generates a score for you. Again, on the bottom there, we talked about that your business credit report being available to anyone who's willing to pay for it. And next slide, please, Morgan. And so now we'll jump into the 4 major types of credits. You're probably already familiar with them: line of credit, credit cards, vendor credit, and term loans. But on the screen here is line of credit and credit cards. Line of credit is flexible, revolving. So let's say you decide you wanted to open up an account, line of credit for $50,000, and the lender makes that line available to you, but you only needed $5,000 to take care of a business need. With the line of credit, you aren't assessed the interest rate on the total amount that's available to you. What they do is assess the interest rate on the outstanding balance. And once you pay the principal plus interest, the principal goes back into the bucket to build it back to $50,000, but it is available for you if you need to access it more than once. So you can go in flexible if you need to borrow today, or you need more tomorrow, it is available for you. And then in most situations, interest on line of credits are lower than that of a credit card, but I have seen situations where it might be higher, or you may get a better interest rate on credit cards. So just do your due diligence and shop around. You have the large banks, you have the community banks, you have nonprofits, you have credit unions, and all of them do have the ability to offer you business credit, and they may have favorable terms. Line of credit generally makes sense as a short-term access to cash or working capital. Let's say, for instance, we have a company here that is a shaved ice company, and they operate, it's a seasonal business. So in the summer months, they're really busy. And then in the winter, they're not really that busy. So, but they do have a retail location. And so a line of credit might make sense to meet the needs of the business while, in their slow months. So then once that business picks up, they're able to repay the balance back. There are stipulations with lines of credit. So some companies may require that you pay off your balance in the first year. And some of them may assess an annual fee as well. So it's important to compare the features and benefits and shop around with lenders. When you go and generally what you want to do when you do shop around for a business credit, what you want to do is, if you can shop within a 14-day period, the older models, the scoring models for vintage scores, the FICO scores, they would count each hard inquiry as one, as long as you do it within a 14-day window. Now they do have newer models that give you a 45-day window to shop for credit, and that only being a one hit on your credit. But since you don't know which one the lenders will use, just best practice to leave it within 14 days for you to shop around. And then on the credit side, of course, credit cards are revolving lines of credit. They help you meet short-term needs, but mainly everyday business expenses, just because the interest rates are a lot higher. And so they would not be suitable for large purchases, especially if you could strategize, because some lenders do offer you a certain amount of terms, let's say 18 months, no interest. In that instance, if your financial statements support borrowing against it and being able to pay back within that 18 months to save yourself interest, that's definitely a strategy you could use. But also with credit cards, the interest rates, it doesn't begin to accrue until, I believe, 25 days. So if you can find out what the rules are, if you borrow from it, pay it before interest begins to accrue, then you're saving yourself on some interest there. It's a great way for newer businesses to begin separating their personal from business credit, just, for reporting purposes and liability purposes, using that, whether that's for gas, office supply. It's a great way to begin to separate it. A great benefit to credit card, I think, is because you're able to order additional cards for employees. So if you run a company with a lot of sales rep and they need to take out a customer, or if you have a receptionist and you're not in the office and they need to make a purchase, most institutions will let you order additional cards for your employees, and you get to set the stipulations. And of course, you should do your due diligence to make sure that the employee should have a company card. And a benefit, again, to credit cards is the ability to earn cash back so you can reinvest the money into your business. Shopping with the rewards does, making sure that you know what the terms are on the credit card, so you know which companies to use so you can get some money back into your business. Again, they're generally not suitable for larger purchases just because of the interest rate, and you may end up overpaying for the item. And then the last two are term loans. So term loans are also known as installment loans. They're a fixed amount that you borrow, and of course, it's very transparent, so you know what you owe and what when you need to pay it back. Generally, some businesses might find it beneficial to know what to expect so they can project that into their debt. So if you know you need to pay $200 for the next 5 years, you can kind of work that into your liabilities. So that might be a good idea there. Term loans do come with several different, they are variable. So you could get a term loan for equipment, for commercial needs, or depending on what type of industry you're in, a practice loan for healthcare industries. They do have specific terms and special loans to help you in that area. You could potentially decide to open a term loan under the secure method or an unsecured loan. So a secure loan meaning you are pledging asset against the amount that you're borrowing, so it reduces the risk for the lender. If you were purchasing the vehicle, you could use the vehicle as a collateral. If you're purchasing commercial real estate, you can use that as collateral. Generally, when you do that, it does give you a more favorable term. And it also allows you to borrow a larger amount because it does reduce the risk for the lender. If it's unsecured, it depends heavily on your credit history and your credit report. So just keep that in mind. Generally, they are used for larger purchases, again, because it's transparent, and the interest rate can be flexible depending on which route you choose to go with. And then vendor credits are known as a net 30 account. So it's an in-house account that some vendors offer you. I know Uline does, Granger does. There's a couple of office supply companies who also offer you vendor credit. So you buy now, you pay later. In terms of a company who is inventory heavy, or a company who you have to deliver the product before your customer pays you, before you receive payment from your customer, this might be a good option that the vendor might offer you. So you can, fill orders, and as they pay you, you can pay them back. It's a good option for you to stretch your cash flow because, you're not having to put anything down. So other access to funds that you have, you can relocate them or allocate them into other areas of your business. Vendor credit can help you build credit for those people who have challenges with their personal credit and don't necessarily want that to be included when the institutions do run your credit. So you could start building business credit through requesting access or working with vendors who offer vendor credit as well as report to the credit reporting agency. So you want to make sure that they do report to the credit reporting agency if that's your strategy. Next one. All right, so I think it's important before you decide to secure credit for your business, I think it's very important for you to ask yourself a couple of questions. And first one is, are your financial documents up to date? You know, did you update them the last time you acquired a new customer? Did you update it the last time you acquired new debt? And if that information is up to date, you should be able to examine if you have any excess cash that you can reinvest into your business. That would reduce the risk of having to get a loan and having to pay interest on that. And then, is this going to be a short or long-term expense? Knowing this information helps you decide which avenue in terms of which credit to pursue that would make sense for your business. And of course, the last one is, will it provide more value than the cost of financing? Do you have any alternative? Because you certainly don't want to buy an item that you could potentially lease. And when you buy it, you end up paying more for it, especially items that could potentially depreciate. So if they only have a lifespan of 5 years, but the loan is going to take you 10 years or 7 years to pay off, that might not make business sense to go that route. It may be, wiser for you to finance or look for alternative options. I think the next slide is going to open it up for questions. I know we went through that just a little bit quick, so I'll answer any questions that you might have.
Awesome. Thank you so much, Tania. The first question that you had posed to our audience at the start was what they were hoping to get out of it. And you started talking through, but a couple of people mentioned they're hoping to know more about how to check and build their business credit. So like I said, you started talking through, but is there anything specific to those folks you want to add or share there?
Sure. So towards the end of the slide, I'll have some resources for you in terms of how to access your credit report. Business credit is, your business credit report isn't necessarily free for you to access like your personal, but I do have 5 agencies listed under resources that do offer you access to a free business credit report, either one time or they have other options for you. But generally, building business credit, looking towards a credit card, to help you separate your business expenses that can help you build it, and making sure that your credit utilization rate is low. Generally, you want to see it below 30%. So if you were to get access to 100,000, only use 30,000 of that, because that's going to factor into your credit score. So keep your utilization low. And make your payments on time. And of course, as business owners, we have multiple competing priorities. So if you can set up auto pay, just to have that taken care of, you don't have to worry about it. That can also help you. But again, using vendor credit, and you could potentially even get a charge card where you put $3,000 down, the bank makes available for you $3,000 for you to access in the charge card. Some will report to credit reporting agencies. Capital One does. So different things like that should help you build business credit.
Great. And taking that one step further, one of the business owners on the line was saying how this, what this building that business credit means for their company's potential expansion. So if there's anything that you have to add around that too.
Sure. Having a good business credit does allow you access to money. So let's say if you were looking to expand and you need capital to do so, having a good business credit report will help you gain access to it, and especially getting favorable terms. But it's mainly giving you that access to inventory or access to expand your business. That's why it's important for you to have business credit. Also, because your potential customers and partners do check your business credit, so you don't want to lose customers just because you struggle with your business.
Great. We've got while we've got the questions open, feel free to use the Q&A box or the chat box to ask your questions for those of you who are just joining us. The next question we have is, what type and frequency of activity should you have with a vendor that offers net 30 terms in order to build a credit profile?
I would definitely reach out to the vendor, but making sure that as soon as you open up an account with them, if you're making your payments, they will report that information to Dun and Bradstreet. That's the company that they use they specifically work with vendors and suppliers. So they report that information over time. I would give it at least 6 months or a year to have that history going. But if there's something else that you could do to potentially increase it, because Dun and Bradstreet, the paydex score is based on your payment history. So you want to see a couple of payments there, a couple of frequencies of payments for you to build that up.
Perfect. And we had one question. Somebody had came a little late and asked you to talk about Dun and Brad. Let us know if there's anything specific, or Tanya, if there's anything generally you want to share in the meantime.
Again, their focus is exclusively on your business credit. They do offer you access to your business credit, but of course they want you to pay other things. They want you to purchase other items. So, but they are one of the companies that most creditors or lenders will access. They're one of the major players because that's what they do. Experian and Equifax, they have the personal side, but Dun and Bradstreet focuses more on business credit. Again, is your relationship with your suppliers, your relationship with not your customers, but your partners. So it could include information about your business in terms of name, address. It could include how you've made payments, as well as any business identifying information like your industry, potentially years in the business, but it's generally focused towards just your relationship with vendors.
Thank you. We've got a question asking, if you have good personal credit and bad business credit, will that make a difference?
I think it depends, because some lenders do require you to personally guarantee on a business loan or line of credit. So depending on the factor that they use, and they all have the different ways of evaluating your credit. So you could potentially personally guarantee for the loan, or they may come up with other options for you to help you acquire credit. But it's just mainly about reaching out to them, find out what they're looking for. They can give you more information on that. But it doesn't necessarily mean, that you're not going to be approved for it, but you can take steps to begin, improving your business credit. If you're struggling with late payments, reach out to the companies, try to see what you can do to catch up, and then setting that auto pay so you don't forget about it. That should help you build it back up.
Yeah, and that was a popular question. We had another question saying, if you have great personal credit but no business credit, will the personal credit play a part in helping get financing for the business?
It will. Your personal credit is always going to play a factor because you haven't established business credit yet. So, and what they want to see is either a personal financial statement that you complete about all of your asset and your liabilities, so they can find out what your net worth is, any outside accounts or assets that you have. But they generally will require you to submit your tax returns. So if you don't have business credit yet, then your personal credit plays a huge factor. But even if you have just a slight bit of business credit, your personal credit still plays a factor. So it's always going to play a factor unless you're a corporation, then it may not.
Mm-hmm. And then we've got questions about the reverse. If you have low personal credit but good limited business credit.
You may have to build that up. Again, using vendor credits, finding those companies. I can't recall the name, but there's an office supply company that does report to Dun and Bradstreet. They offer you in-house credit that can help you build up your business credit. But it's all about, finding out what information you have. And if you're not sure how to read the scores, making sure that you do understand that you can contact, of course, Experian, Dun & Bradstreet, but generally when you do request a credit report, it should explain that information for you. So knowing exactly what you have in your credit report should help you, but it shouldn't deter you from applying because lenders do have several different factors that they use. Small SBA loans, for instance, it's guaranteed by the government, so they may have different criteria. So don't let it discourage you. Reach out to them and find out what they're looking for.
Let's see, we've got another question in the chat asking, is it more difficult to establish business credit if you are a sole proprietor versus an LLC?
I don't believe it is. If you're a sole proprietor, that's really being reported under your personal information. So you may want to try vendor credit, but again, you're using your social rather than your business. So you're personally liable for it. So that's a difficult one.
We've got some questions in the Q&A box. One's asking, how long should you be in business to apply for credit?
Right away. I mean, what you want to do is start building business credit. Generally, when you first start your business, especially for tax purposes or for organization purposes, you go into the bank and you open up a bank account, whether that's a checking or a savings account. At that time, most likely they will offer you, a credit card or talk to you about the options that are available to you. But when you do establish your business account, I would generally apply, begin now to apply for a credit card so you can start separating your personal business from your business credit.
Great, thank you. We've got a question saying that this business owner has a Wells Fargo business credit card. Where should they expect to see this trade line? It does not appear in any of their personal credit reports.
It's possible. Oh, I'm sorry, say that again.
So where should they expect to see the trade line for their Wells Fargo business credit card, because it does not appear in any of the personal credit reports?
It should at least Experian. Have they checked their Experian? Because Experian generally does require a trade line as a minimum to generate information in your credit. But if it's not there, I'd reach out to Wells Fargo. I'm not sure what their rules are in terms of credit reporting, but it's possible that they just have not reported it. But Experian generally requires that. Yeah.
Mm-hmm. Okay, we've got another question from Nicole asking, payment processors like Stripe and PayPal offer loans or lines of credit. Generally, eligibility is based on your sales history and payback is by deduction from future sales. Are those good ways to build your payment history?
I'm not sure that they do report to the credit reporting agencies. I would check with them. I'm not familiar with Stripe or PayPal. Mm-hmm. But if you reach out to them, ask them if they do report to the business, to the credit reporting agencies, they should be able to let you know. Generally, what you want to do is work with a company that does report if it's your goal to actually build business credit. So you have a lot of companies that do not report, so you want to make sure that they do report, and that should be one of the questions that you do ask when you do decide who to work with.
Perfect. This business owner asks, if I have a business partner, should we open separate business credit cards or share one?
Normally, I believe if your business partner owns at least 25% of the business, it has to be done on the business itself. You can each receive a card using your business information. So let's say you went into Wells Fargo. If your business owner owns at least 25%, you both have to be there. You can each apply for business credit card, and you would each receive a business credit card. you can decide that you want to open it under one and then just have your stipulations in terms of what the minimum is per person. But generally, you can have a business credit card and decide how to divvy that up between the owners. So I would suggest that it goes in because it's under the business. If you're not personally guaranteeing it, it should stay within the business and going in, and they'll discuss their option. But generally, if you own 25%, it should be under one business.
Thank you. The next question we have is there a specific task we should be doing in monitoring our DNB account? How do we build our profile?
Yeah, so DNB does offer you the ability to monitor your account or set alerts because, and I think it's a great thing to do if you can afford it. It's not free. You know, in order for us to access our personal credit, that is free. On the business side, it might come with a fee outside of that initial free credit offering. So if they offer it to you, I would, just because you want to know who's checking it. I know on the personal side, if you go and apply for credit, you know someone's going to check your credit. But on the business side, you may not. So if you set alerts and monitor it, you can see what's going in. And also, I think I heard stats that about 40% of there's about 40% of people have erroneous information reported in their credit, something like that. So these companies that we're working with, they're humans and, you know, they make mistakes. So it's important for you to always monitor your credit. You know, on the personal side, right now with the CARES Act, generally we know you have access to a free credit report once a year. With the CARES Act, you have access to it every week. I think that's up to September. So you can go to freecreditreport.com. Once a week, you can request a free credit report. So on your personal side, on the business side, you may or may not have to pay for it, but generally there's a fee. But yeah, I would encourage you to monitor your credit just because, you know, people make mistakes and you want to know what's listed on there and you want to know what the lenders are what they can see or what they will see.
Perfect. And then the last question we've got in the Q&A box may relate to more of the second half of your presentation, but I'll share now. The question is, I was told each bank had different criteria. So when rejected, I should go to 3 to 5 more banks. When do you know you're being rejected for criteria and not for other reasons?
Well, I would reach out and find out what the reasons are. Generally, they will send you a letter letting you know why you were rejected, especially when they factor in your personal credit. But I would find out. I would reach out to them to find out why you were declined. Just so you know, you do have to know. But if you do have to go other routes or work with other lenders, you should, see what's out there because yeah, they do have different criteria, but they should at least let you know why you were, and they do. The bank I work for, did. I don't see why they wouldn't. So I would just reach back out to the banker or the small business specialist that work with you.
And then one more came in before we continue was, do you have any recommendations for which company would be best to apply for a business credit card for the very first time? Personally, they've been with a credit union.
If you like the relationship with the credit union, I would go with them first. I would, if you've already established that relationship, I would go with them. But if not, you have that window that you can shop around. You can go to the lender's website and see what offerings they have. They can offer you information. They can offer you credit based on what interests you. It could be cash back. It could be any number of things. And if you're looking for a no interest APR, certainly find that company that does offer it. But yeah, I would start with if I'm happy with where I am, I would start there.
Awesome. Thank you so much, Tania. And thank you everyone for submitting your questions. That's all we see right now. And we'll see if we have time at the end for more, but I know, Tania, there's more to your presentation, so I'll let you continue.
Awesome. All righty, so now we're going to get more into positioning yourself for success. And generally, lenders have their own specific criteria that they do choose, that they plan to use. But most of them, what they look at is the 5 C's of credit. And that's capacity, credit history, collateral, capital, and conditions. So capacity means, can you pay for the debt that you're looking for? So if you're looking to borrow a $50,000 loan, there's your financial statement support your ability to repay it. So they want to consider what your debt to income ratio is. I think it's important for you to calculate that before you go in. So to calculate your debt to income ratio, just take all of your monthly payments divided by your gross income or revenue, monthly revenue. That should let you know where you are. You want to be below 40%, best practice, 35%. But you also want to make sure when you do request for the funds that you can pay, your projections show that you can make the payments, because the lenders will generally look for that information. And then of course, your credit history, they focus on how have you met your obligations previously. And something else they look at is, what do you plan to pledge? If you're looking to borrow to finance a vehicle, are you pledging that vehicle as collateral? Do you have any assets that you're willing to pledge as collateral? And especially for those who have struggled with credit on one side or the other, if you have collateral, they may reconsider. So these are things factors that they look at, not just specifically your credit score or your history. They take all of that into consideration. And then capital, do you have any investments? If you cannot repay your loan, do you have any possible investments or asset that they could seize or they could use for you to repay your loan? And then conditions. That's a big one with the COVID-19. We know, unfortunately, restaurant industries have suffered greatly. So vendors will consider that. What's the condition of the economy? What experience do you have? And does your financial statement, your business acumen, does that show that you can beat your competitors? Does that show that you can survive at several economic conditions? So that's something that they consider as well. So it's important not to focus on just the score, but focus on, this is all the information that they take into consideration when they decide, on a decision for your credit. They want to extend it to you. All right, so simple steps for you to take. What amount do you need? So, making sure that you can afford to pay it back based on your projections. Make sure you calculate your debt to income ratio. And a best practice, I would recommend, once you figure out what your debt to income ratio is, shop around. Many of the credit unions or financial institutions do have certain tools that can help you figure out what the payment would be for someone in your situation. So that's how based on the amount that you're borrowing, based on your credit score, what do you fall under? So they'll give you some scenarios, and then go back and recalculate your debt to income ratio, because knowing where you stand after you receive this debt will help you plan for any future costs. So always knowing where you stand financially. And then understanding your options, leverage the banking institution. The one I worked for, I sat down with the business owners, completed a business needs assessment, and many business owners don't know what their expenses are. So sitting down in front of someone, getting all that information out, and then they may make a recommendation in terms of, based on your business, what option would be best for you. And then talking to your financial professional or your CPA, they can help you determine, based on your overall situation, which option would be best for you. And then, of course, reviewing your credit. Pull your credit, find any weaknesses, find any discrepancies, and take steps to fix it before you go and apply for credit, so you can improve your scores. And then last is just making sure, most of them will require at least 2 years of tax returns. So making sure you have that information available, your balance sheet, your income statement, your cash flow statement, have that information in front of you. Make sure it's up to date. because once you submit your information, your vision needs to be on paper because they need to see that. What you see, they need to see it. So if you need to go back in, if you just recently acquired a new customer, go in and add that so you can show the projection for, the revenue that you plan to get from that customer. So update all of that information, depend on the type of loan that you do apply for, especially SBA. They may require you to submit a business plan. So making sure your business plan is available, or some bank statements or proof of registration as well. All right, so some best practices for you. I think it's really the same on your personal and business side, with just maybe just a slight difference. On your personal side, it's important for you to save, have it as an emergency fund, at least 3 to 6 months worth of expenses that you only touch in an emergency. You don't want to go borrow money to cover an emergency. Strive to maintain that in an account. And then pay your debt on time. Don't wait until the due date. Try to pay it on time. Equifax will generate your score based on when you do pay it. So if you have a habit of making late payments, that can get pulled into your credit score. Keeping your credit utilization low, below 30% is ideal. And then avoid accounts going into collections, especially doctor bills, medical bills. We get bills. They come in before you know it, they send you one notice and next thing you know, it's on your credit. So making sure that you take care of that because, that's not expected. So make sure that's paid off. And then shop for a loan or credit within a certain time frame. 14 days is ideal, best practice, but some will allow you to do it within 45 days. Avoid closing old accounts with no balance. You don't have a balance in it, don't rush to close it because the age of your credit does play a factor in your credit score. So if you open an account 7 years ago, you close it, and now you have a new account that you opened last year, you're removing that 7-year history that you had. So try not to close it. And if the institution closes the account, reach out to them, see if they can reopen it. And if not, just, it's not much we can do there, but try not to close it. If you have to, maybe use the account for gas, $25 gas, and pay it right off, at least you have that going there. And then monitor your credit. Again, a lot of, you'd be surprised how much incorrect information is in your credit file. So could be in your credit file. So if you pull that information, make sure that what the lenders see is what you see, and keep trying to keep that up to date. I know it's tough because you're right. You're a one-man show, one-woman show. So it's tough, but it's just one of those things that make sure that your business financial health is in order. All right, on the business side, I think it's important, general best practice, to make sure you maintain at least 12 months worth of working capital. To give you an example, when the COVID-19 hit, a lot of the banking institutions stopped offering new bank loans, new loans, new lines of credit. So if you didn't establish it before, you may have had a hard time trying to establish it because they were trying to reserve capital because no one knew what was going to happen. So the one I worked for completely stopped it. So you had no access to it. So that presents a challenging situation for your business. So it's difficult, but if you can find ways to reduce cost and start, putting that aside for emergencies. And then maintaining good relationship with your vendors and your suppliers, making sure you pay on time, that can play a factor in your credit score. Separating your personal and business credit prevents liability. So if you have a sole proprietor versus LLC, taxes are different in those. So trying to keep that separate for tax reasons makes your CPA's life a little bit easier. But it also helps separate your personal assets from being liable. And then monitor your credit, your business credit, especially knowing that, when someone checks it, you don't know. So if you can set some alerts on there, I think that'll be beneficial for you to know who's checking your credit and why they may be checking your credit. All right, so this is the resource page I mentioned earlier. It has all the information for Dunn and Bradstreet, as well as Experian and Equifax. And then on the right-hand side is those are the companies that do offer you free business credit report. Number 4, Dun & Bradstreet, they do, I believe the initial one is free. They want you to purchase other items, but those companies do offer you a free business credit report. Nav.com is a great credit resource. They have a wealth of information for small businesses if you're looking just for credit. So when we leave, you can search nav.com. Is there something I haven't covered? You may be able to pull that up, but I think it's a great information resource. I use it for my business, and so I'm glad to share it with you guys here today too. I think that's it. So I mean, I hope this was good for everyone. I hope it was a good investment of your time. I hope that you took something out of it. And thank y'all for having me. I'll take any questions.
Awesome. Thank you so much, Tania. We will, like you said, we'll take a couple of questions if anyone else has any questions. One came in was, could you explain avoid closing out old accounts with no balance?
Yeah, so on the personal side, the age, it's called the age of your credit, plays a factor in your credit score. So the longer you can show that you have experience with credit, the better. So let's say you had a credit card account that you established 5 years ago, or even some kind of a store credit for furniture. If you leave that open, it does help with the scoring aspect of showing that you've had experience with credit. So trying not to close those accounts does help your credit. So that's what I mean by that, because it's a certain percentage of your credit score. So try to leave that open, and so you have that history there.
Thank you. We have a few more minutes together here, so if you have any questions, feel free to drop them in the Q&A box or the chat box. Like I shared in the chat, I will be sending out a recording from today, as well as the slides that Tania had put together for us in an email, either later today or tomorrow. So you'll have access to rewatch, revisit the information with, later, or with your team, or whatever it may be. So you can expect that in your inbox later today or tomorrow. Any last questions for Tania before we go? Oh, here's one that came in from Mary asking, what is a good way to start building your business credit as opposed to your personal credit? And are there any vendors that you suggest?
Uline, I think they have different offerings. Uline can help you with vendor credit. Granger is another company. And there were 2 more, I can't recall who they are, but with office supplies. I think it's maybe Summa, SUMMA, office supply. That might be another company you could try. But try Uline. They have a great offering, but I would call around and see what companies are offering business credit, depending on what you're looking for.
Thank you. Another question came in asking, is it wise to wait a year or 2 after turning a profit to apply for business credit?
I don't think there's a negative or positive effect on that. I guess it just depends on what your goals are or why you prefer to wait. I think that's more of a personal choice. But certain business lenders may require, if they're only going to focus on your business, for you to have at least 2 years of history, especially when you're borrowing a large sum of money and it's an unsecured secured loan. So they may require you show history of profit in your business. So I think it just depends. It depends, but generally it's not required.
Great, thank you. And we see lots of comments coming in thanking you, Tania, for your time and sharing your expertise with us. Some really great information shared, and I know a lot of business owners in our community on this call will benefit from learning from you here today. So thank you, thank you, thank you.
Thank you all for having me.
Absolutely. I'll give one last call for questions. Oh, and one did pop up. This business owner is asking, should a business maintain a certain account balance when asking for a loan?
So are we talking about when you borrow and you want to make sure you have more in terms of available or outstanding? Just a little bit more information.
Available.
Yeah, I think so. Just on the side, because your utilization plays a role in your credit score. So trying to keep that low is important, and having cash available. So being strategic in what you need to purchase and why you need it. And is it something that's in your business plan? And if it's not, updating your business plan. But yeah, I mean, more cash is available. The less you borrow, the better. But when you do borrow, try to keep that rate, especially when it's a line of credit or credit card. Term loans are they're reported in your credit as a whole because they give that whole amount to you. But yeah, just if it's a revolving line, try to keep that between below 30%.
Thank you. We have another question asking, as a mobile yoga studio, what is the best type of capital to access for back-end needs?
I think it depends on your individual situation. A line of credit sounds like it might help you meet, some of your needs, but I really think it depends on your individual situation. So I would encourage you reach out to the bank, complete a needs assessment, so they can learn more about your business, more about your spendings, more about some of the expenses that you have, and they can direct you in the right direction. But without really knowing all of that information, I don't think I can't make a recommendation because I don't have the whole picture.
Yes, completely fair. And, if you, I think that was Kenyatta, if you would like to work with a business advisor from Pacific Community Ventures to get that understanding of your specific situation, for one of our advisors to make some recommendations and some suggestions, we encourage you to sign up and work with an advisor through PCV if you aren't already. We've got another question asking, how important is it to have a business savings account in addition to the operating account?
To meet unexpected emergencies, I think it's important for you to have that. So, not having to dip into your operating account for unexpected emergencies. I think I think it's important for you to have excess cash because you want to have a savings account to meet other needs, that in case something happens with your business and you need that access to capital, you have it. More cash reserves, the better. So I think it's definitely important for you to have a business savings account and a working capital account.
Perfect. And then the last question I see, because I know we're a minute over, and I want to respect your time. The last question I see is, what steps do you suggest for a business just starting out foundationally to prepare themselves before ever actually applying for credit?
I would establish a bank account. Establish a bank account is the first thing you should do. And then maintaining good relationship with all of your customers, your vendors that you're working with, because you never know. So that's the first thing I would do, is establish a business account so you can start separating those expenses. You can keep a record of those expenses as well. And if you do, are you starting a business? If you're starting a business with seed money, you definitely want to keep a report of your expenses, your receipts, so you can claim that in your taxes. So yeah, just having a business account. The first thing you should do is separate your business from your personal. As a business owner, we have three needs. So our personal needs, the needs of our business, and the needs of our family. And we never want one to overshadow the rest. So making sure that you have that foundation set up for you.
Awesome. Well, thank you again, Tania, for sharing your time and expertise with us here today. And thank you for everyone on the call for joining us, spending your afternoon with us, asking these great questions to start this really great conversation. Like I said, I'll follow up either later today or tomorrow with a copy of the presentation slides and a recording from today, as well as all of the links that Tania and I have mentioned throughout this presentation. Yeah. I guess with that, I'll say thank you again and have a great week.
Thank you. Bye.